Taking on $25 billion in Salesforce's long-term debt strictly to buy back stock sounds like a desperate move. Yet Salesforce is doing exactly this while posting record profitability. But does this mean the market is completely wrong, or is there a hidden fundamental flaw that Wall Street is ignoring? Let us uncover the absolute truth right now by digging into the numbers. Total revenue came in at $11.13 billion this quarter. Total revenue simply measures all the money brought in from sales before any operating expenses are deducted. But how much of that top-line number represents new customers actually buying more software? Headlines are screaming about a solid year-over-year revenue growth of 13%, celebrating what looks like a resilient enterprise cloud business. But when you look closely, you realize inorganic growth is doing the heavy lifting. The fundamental reality is that this quarter included a strategic acquisition revenue contribution of $444 million from their recent Informatica purchase. Strip away that acquired revenue, and the core Salesforce organic growth engine is showing signs of fatigue. We are looking at a legacy software platform. Think of static sales dashboards used by office workers. That might be nearing maximum market saturation. Proper stock market analysis requires you to separate purchased revenue from organically earned revenue to understand true product demand. Slowing organic growth brings us to the elephant in the room regarding how management keeps the stock price elevated despite saturation. Long-term debt exploded to $39.3 billion this quarter. Long-term debt is borrowed money that does not need to be repaid within the next 12 months. Why would a highly profitable software giant suddenly leverage its pristine balance sheet so aggressively? Most analysts are purely focused on the resulting earnings beat, completely ignoring the structural risk being added. The general consensus assumes this borrowed capital is being used to build massive physical infrastructure, like new artificial intelligence data centers filled with advanced microchips. Instead, Salesforce initiated an accelerated share repurchase program of $25 billion. They are literally borrowing money to buy back their own stock at peak valuations. This debt-funded buyout shrinks the outstanding share count to artificially inflate future earnings per share. What does this shift in capital allocation mean for your portfolio? It means this earnings strength is driven by financial engineering rather than genuine business expansion. Solid investing strategy demands that we look beyond the surface of these massive corporate buybacks. This brings us directly to a seemingly unrelated metric hidden inside the cash flow statement. Free cash flow reached an incredible $6.55 billion for the quarter. Free cash flow is the cash left over after a company pays for operating expenses and physical capital investments. Wall Street is entirely captivated by this figure, especially the resulting free cash flow margin of 59%. That massive margin proves the cash minting power of the underlying Salesforce software ecosystem once a corporate customer is locked in. But when you dig into the footnotes, you find this cash generation is subsidized by an immense stock-based compensation of $870 million. Stock-based compensation is a tangible cost used to pay software engineers, and it continuously dilutes ordinary investors like you. Furthermore, you will see that 26% of the reported GAAP net income was driven by volatile, non-operating gains on strategic investments. GAAP net income represents the official bottom-line profit required by accounting standards, but here it includes one-time investment windfalls. Despite these concerning maneuvers, Salesforce is achieving something incredibly rare in the technology landscape. Agentforce annual recurring revenue just crossed $1 billion. Annual recurring revenue measures the predictable, locked-in subscription money a company expects to receive every single year. The popular viewpoint right now is that enterprise software providers are spending billions on artificial intelligence without any clear path to making that money back. Yet, Salesforce introduced a highly specific consumption metric, reporting the delivery of 3.8 billion agentic work units. An agentic work unit is a measured task performed by their artificial intelligence, like automatically drafting a personalized sales email. This signals a strategic shift toward usage-based billing where customers pay more as they consume more computing power. This early monetization success validates the pivot management has made, but it creates immense pressure to sustain this momentum in upcoming quarters to justify capital expenditures. True fundamental analysis shows us that this metric leads directly to the massive promises management is making for the rest of the calendar year. Current remaining performance obligations hit $33.6 billion this quarter. This specific metric represents the total contracted revenue that has not yet been recognized, but is expected to be billed within the next 12 months. A lot of commentators are completely focused on the year-over-year backlog growth of 14%, seeing it as guaranteed money sitting in the bank. It certainly provides strong short-term billing visibility for Salesforce as they navigate global uncertainty. Relying on this visibility, management confidently raised their full-year revenue guidance midpoint to $46.1 billion. However, to actually hit that lofty number, Salesforce requires a significant organic acceleration in the second half of the year. If broader economic conditions prompt cautious enterprise clients to simply delay their corporate IT spending, choosing to wait before upgrading their critical cloud infrastructure, this optimistic guidance suddenly becomes a severe liability. This delay would heavily punish those who bought at the peak today. If you are applying sound fundamental analysis, you have to realize that management projections assume perfect economic weather without any disruptions. Which brings us back to our opening question. Is the massive debt-funded stock buyback a sign of fundamental strength or a desperate attempt to mask an aging business model? The ultimate verdict is that Salesforce has successfully transformed into a phenomenal cash-generating machine, but it is no longer the hyper-growth innovator it once was. The double-digit top-line revenue growth is becoming structurally reliant on costly acquisitions. By issuing massive amounts of long-term debt to fund share repurchases, management is effectively masking slowing organic growth and offsetting the severe dilutive effects of heavy stock-based compensation. So, does the current valuation offer a safe harbor for your portfolio, or is it a carefully engineered value trap? For the intelligent practitioner of value investing, Salesforce represents a slowly maturing cash cow that is aggressively financially engineered to maintain its premium market multiple. It is not a pure value trap, thanks to its industry-leading capacity to generate elite free cash flow and a massive backlog of locked-in enterprise clients. This cash flow provides a robust safety cushion despite the newly leveraged balance sheet. However, a smart investing strategy dictates that you must adjust your expectations. This is a mature capital allocator navigating the tricky transition from seat-based licenses to usage-based artificial intelligence. Invest carefully with the clear understanding that the high premium you pay today requires management to perfectly execute their ambitious rollout without any delays. But I want to hear your take. Do you think Salesforce can successfully transition legacy clients into this new usage-based pricing model, or is this massive debt pile a ticking time bomb for the stock? Let me know in the comments. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.